Okay, exercise 914 is related to 913. I believe your authors have more sequels than Star Trek. Anyhow, in 913 we had our 7% bond selling in a 7% market. Now we have our 7% bond selling in an 8% market, so the bond sells for a discount. So when we record that at the inception, when we first sell the bond, and we'll do them at the same time here, we have the discount on bonds payable as the difference between the $600,000 in bonds payable and the amount of cash we received. And altogether, I think that's, let me get that number, I didn't do that, I should have, sorry. That's $40,260 discount on bond payable. That's the amount we're going to be using up as this bond marches towards maturity. So our first interest payment, now remember this is annual interest, and what we're actually going to be sending out is $600,000 is the amount of money we borrowed times 7% times 12/12. So we're actually sending out $42,000. That's how much we are sending out, and that's going to be the same every year. That's the stated rate, the face rate, the coupon rate. Every year we're going to be sending out $42,000. The interest expense is really the market rate times the carrying value. So 8% of $559,740 is our interest expense, and that comes to $44,779 and a few pennies. The increase in carrying value is the difference between the $42,000 that we send out and the $44,000 that is the actual interest at market rate. So that's $2,779. And we're going to add that to our carrying value. Add that to that. And the new amount is $562,519. So let's go do the journal entry for that. We're sending out $42,000. Our actual interest expense is $44,779. We're amortizing, we're increasing our carrying value by $2,779. So the cash that's going out is $42,000. The actual interest expense is $44,779. Actual interest expense $44,779, and the difference between the interest expense and what we're paying is the amount we're amortizing, and that's $2,779. That's the amount of discount we're amortizing, and that increases the carrying value of the bond. Okay? Time flies when you're having fun. Here it is, one full year later. I'll use a different color. Now we should be spending 8% of $562,519, and that's $45,002 and a few pennies. The difference between what we're sending out and what we should be sending out is $3,002. That gets added to our carrying value, and that gives us our new carrying value of $565. 5/21. Let's do our journal entry. We're going to debit cash. We're going to credit cash, 42,000. We're going to debit interest expense, 45,000, and we're going to credit our, sorry, that should be over there. Credit our discount on bond payable. So our interest expense should be $45,002. We're actually sending out 42,000. The difference between what we're spending and what we should be spending gets added to the carrying value of the bond. You see that right here. And that's $3,002. The cash we spend plus the amount of discount we amortize is the total interest expense. The same for the year before, although I wrote the number in the wrong spot, I apologize. I'm hoping that you all looked at that and said, "Dope, wrong spot." Send me an email. Let me know what a jackass I can be sometimes. Nah, never mind. My wife tells me all the time. So, and we would continue to do that year after year after year until at the end, the carrying value of the bond is $600,000. It is equal to the face value of the bond at the end.